In 2008, while everyone was panicking about the financial crisis, Warren Buffett spent $5 billion on Goldman Sachs stock. People called him crazy. Today, that investment is worth over $10 billion. Meanwhile, you and I stress about spending $100 on something we're not sure about. What's the difference? It's not that billionaires have more money to lose. It's that they see risk in a completely different way than we do. They've developed a mental framework that turns what looks like massive risk to us into calculated moves for them. And here's the thing. This isn't about having billions. It's about rewiring how your brain processes uncertainty. Subscribe and comment your favorite topic below. Most of us have been programmed to see risk as something to avoid. Your parents probably told you to get a safe job, save your money, don't rock the boat. Society rewards playing it safe, right? Wrong. Here's what happened to me last year. I had an opportunity to invest in a small tech startup. The potential returns looked incredible, but I kept thinking about what I could lose. What if it failed? What if I looked stupid? What if? Sound familiar? I passed on the deal. That startup just got acquired for 50 times what I would have invested. But here's the kicker. I wasn't actually protecting myself from risk. I was guaranteeing a different kind of risk, the risk of staying exactly where I was. Billionaires understand something we don't. They know that not taking action is often the riskiest move of all. While we're calculating what we might lose, they're calculating what they'll definitely lose by doing nothing. Jeff Bezos calls this regret minimization framework. When he was deciding whether to leave his secure Wall Street job to start Amazon, he didn't focus on the chance of failure. He focused on whether he'd regret not trying when he was 80 years old. The risk of regret outweighed the risk of failure. This isn't about being reckless. It's about redefining what risk actually means. We think risk is the chance something bad might happen. They know risk is the certainty that nothing will happen if you don't act. Ray Dalio, founder of the world's largest hedge fund, has a rule. For every decision, calculate not just what you might lose, but what you're guaranteed to lose by not acting. This shifts everything. Let's break this down with a simple example. You're offered a promotion that requires relocating to another city. Most people focus on the risks: new place, leaving friends, uncertainty. Billionaire thinking focuses on the opportunity cost. What happens to your career trajectory if you stay put? They've learned to quantify missed opportunities. While you're worried about a 30% chance something might go wrong, they're calculating the 100% chance that staying still means missing growth, learning, and connections. Mark Cuban talks about this constantly. When he sold his first company, Broadcast.com, to Yahoo for $5.7 billion, people questioned the timing. The dot-com bubble was at its peak. Cuban wasn't thinking about whether the market might go higher. He was thinking about the opportunity cost of holding onto a single asset when he could diversify into multiple investments. This mindset extends beyond money. Time is their most valuable asset. Every hour spent on low-impact activities is an hour not spent on high-impact ones. Every relationship that doesn't add value is taking energy from relationships that could transform their lives. Here's what's fascinating. They don't see this as cold or calculating. They see it as honest. Instead of pretending all opportunities are equal, they acknowledge that some choices compound over time, while others keep you running in place. The math is simple, but brutal. If you're growing at 3% while the world around you is growing at 10%, you're not staying still. You're falling behind by 7% every single year. That's the hidden risk nobody talks about. Most people crave certainty. Billionaires have made peace with uncertainty. More than that, they've learned to use uncertainty as fuel. Warren Buffett has a famous quote: "Risk comes from not knowing what you're doing." Notice he didn't say risk comes from volatile markets or economic uncertainty. Risk comes from lack of knowledge and preparation. This changes the game completely. Instead of trying to eliminate uncertainty, they work to eliminate ignorance. They study, research, build networks, and gather intelligence until they understand the landscape better than anyone else. When Elon Musk decided to enter the space industry with SpaceX, everyone said he was crazy. The risk seemed enormous. But Musk had done something most people don't do. He'd calculated the actual probabilities. He knew that historically, new rocket companies had about a 10% success rate. But he also knew that most failures came from predictable problems, insufficient funding, poor engineering, or unrealistic timelines. By addressing these known failure points, he significantly improved his odds. What looked like a massive gamble to outsiders was actually a calculated bet based on superior information and preparation. Here's the paradox. The more comfortable you get with uncertainty, the more certain your long-term success becomes. Billionaires embrace short-term volatility because they understand that all meaningful growth happens in the uncertain spaces between what is and what could be. They've learned that the biggest risk isn't taking a chance on something that might not work. The biggest risk is being so afraid of uncertainty that you never discover what you're truly capable of achieving. While most people think in terms of 50-50 chances, billionaires hunt for asymmetric opportunities. These are situations where the potential upside massively outweighs the potential downside. It's not about taking bigger risks. It's about taking smarter risks. Nassim Taleb calls these positive black swans, rare events with enormous upside potential. The key is positioning yourself so that when these opportunities arise, you can capitalize on them without risking catastrophic loss. Here's how it works in practice. When Richard Branson started Virgin Atlantic, he negotiated a deal with Boeing that let him return the plane after 1 year if the airline didn't work out. This wasn't reported widely at the time, but it changed everything. His downside was limited to 1 year of operations costs, while his upside was unlimited. Most entrepreneurs would have focused on raising enough money to buy planes outright. Branson focused on structuring a deal where he couldn't lose everything even if he failed completely. Same opportunity, completely different risk profile. This principle applies everywhere. When billionaires invest in startups, they're not necessarily expecting every investment to succeed. They're building portfolios where one massive success can cover dozens of failures. They're playing a game where they can be wrong 90% of the time and still come out ahead. The mathematics are compelling. If you make 10 investments, lose your entire investment on 9 of them, but make 50 times your money on the 10th, you've multiplied your total investment by 4. Most people can't handle being wrong 90% of the time. Billionaires have trained themselves to focus on the overall portfolio performance, not individual wins and losses. This requires a fundamental shift in how you keep score. Instead of measuring success by your win rate, you measure it by your overall returns. Instead of trying to be right all the time, you focus on being dramatically right when it matters most. Billionaires don't make decisions in information vacuums. They've built systems to gather, process, and act on information faster than anyone else in their field. This isn't insider trading. It's superior pattern recognition and network effects. Bill Gates reads 50 books a year. Warren Buffett spends 5 to 6 hours daily reading financial reports, newspapers, and industry publications. They're not doing this for entertainment. They're building information advantages that compound over time. But here's what's really interesting. They don't just consume information passively. They've developed frameworks for turning information into actionable insights. They know which signals to pay attention to and which noise to ignore. Charlie Munger talks about mental models, cognitive frameworks that help you understand how the world works. He's collected dozens of these from different disciplines: psychology, physics, economics, biology. When facing a decision, he runs it through multiple mental models to spot patterns that others miss. For example, when Amazon was just an online bookstore, most people saw it as a niche business with limited potential. But some investors recognized the network effects model from other industries. They understood that the company with the most customer data and the most efficient distribution network would eventually dominate not just books, but everything. This isn't about being smarter than everyone else. It's about having better frameworks for processing the same information everyone else has access to. They've learned to spot trends before they become obvious, identify inflection points before they happen, and recognize value where others see only problems. The key is building systems for continuous learning. They're not just reading random articles or watching random videos. They're systematically building knowledge in areas that compound over time. They treat learning like an investment with compound returns. When they make decisions, they're not just using current information. They're drawing on years of accumulated knowledge and pattern recognition. What looks like intuition to outsiders is actually the result of systematic preparation. Most people optimize for immediate results. Billionaires optimize for compound effects over decades. This fundamental difference in time horizon changes everything about how they evaluate risk and opportunity. Jeff Bezos talked about this when building Amazon. While Wall Street pressured him for quarterly profits, he focused on building systems that would compound over 10-20 years. Customer obsession, long-term thinking, and willingness to be misunderstood became core principles. The math of compounding is brutal for those who don't understand it, and magical for those who do. A 1% improvement every day leads to being 37 times better over a year. Small advantages compound into enormous advantages over time. This is why billionaires can appear to take massive risks that would destroy normal people. They're not actually taking bigger risks. They're playing a longer game where short-term volatility becomes irrelevant. Warren Buffett's average annual return over 50-plus years is about 20%. That doesn't sound dramatically different from the market average of 10%. But compound that difference over decades, and it's the difference between having millions and having billions. They understand that the most powerful force in investing isn't intelligence or luck. It's time. The longer your time horizon, the more risks you can take because you have more time to recover from mistakes and benefit from compound growth. This extends beyond money. Relationships compound. Knowledge compounds. Reputation compounds. Systems compound. They're constantly building assets that become more valuable over time rather than just trading time for money. The risk reversal is complete. What appears risky in the short term, investing in unproven technologies, hiring expensive talent, building costly infrastructure, becomes the safest long-term strategy. What appears safe in the short term, keeping cash, avoiding change, playing it conservative, becomes the riskiest long-term strategy. They've learned that in a rapidly changing world, the biggest risk is not adapting fast enough to stay relevant. So here's what we've uncovered. Billionaires don't see risk differently because they're wired differently. They see risk differently because they've trained themselves to think differently. They've flipped the script on what risk actually means. Instead of asking, what could go wrong? They ask, what will definitely go wrong if I don't act? Instead of trying to eliminate uncertainty, they've learned to use it as fuel for growth. They understand that the biggest risk in today's world isn't taking a chance on something that might not work. The biggest risk is being so afraid of change that you guarantee yourself a future that looks exactly like today. The frameworks they use aren't magic. Asymmetric risk, information advantages, compound thinking, these are learnable skills. The difference is they've made learning these skills a priority while most people hope things will just work out somehow. Your next opportunity to apply this thinking is probably sitting right in front of you. That project you've been putting off because it might not work. That conversation you've been avoiding because it might be uncomfortable. That investment you've been researching but haven't pulled the trigger on. What's the real risk? Is it the chance that your action might not work perfectly? Or is it the certainty that inaction guarantees you will be in the exact same place a year from now? Here's what I want you to think about. What's one decision you've been putting off because you're focused on what might go wrong instead of what will definitely stay the same if you do an act? Drop a comment and let me know what that decision is. Sometimes just writing it down changes how you think about it. And if this shifted how you think about risk and opportunity, hit that subscribe button. We're building a community of people who refuse to let fear disguise itself as wisdom. Subscribe and comment your favorite topic below. What topic should we tackle next? The psychology of wealth building. How successful people think differently about time, or something completely different. Let me know in the comments.